Guys, welcome to yet another episode. For those of you who follow the market, you know that things have been exciting lately with the technology sector continuing to rise, breaking all-time highs, with Bitcoin surpassing 100K for the first time. Of course, as always, traders have different opinions on what this means and what's going to come next. Some are bullish like Tom Lee, while others are bearish like Michael Burry. And that's mainly based on their different analysis styles and methods. This is where the advantage of being an investor instead of a trader becomes obvious. Investors see compounding and dividends as key growth drivers and therefore have a long-term perspective, which allows them to avoid the risks and distractions assumed by traders as they aim to produce capital gains with the probability of positive outcomes hinging on mostly unpredictable external factors. This is why in the long term, traders usually fare worse than investors. This is supported by multiple studies and statistical analysis highlighting behavioral biases and structural inefficiencies in short-term trading. Nevertheless, let's see what Tom Lee, a prominent bullish market analyst and strategist, has to say about the current US market and Bitcoin.
Strat Global Advisors Head of Research Tom Lee joins us on set today. Hi, Tom.
Hello.
So based on what Taneo was describing with regard to Bitcoin, what do you think that this most recent rally says about the overall risk appetite in the market right now?
Well, it's really telling us investors are pro-risk. I do think it also just signals how much capital has been idle for the last couple of years, either parked in money market cash or waiting to see if the economy survived. So I think Bitcoin rising is to me, breaking out of a holding pattern is a precursor to what the S&P is going to do the rest of the year.
Speaking of the moves in the broader markets, you say the road to 6,300 is paved with bumps. What do you expect investors to see ahead that may slow them down? What are some of the key markers that you're looking for?
Well, I think there's a lot of macro to digest the next 3 weeks. Tomorrow is the jobs report, and I think investors are fearful that it's going to be too strong because of the hurricane and seasonal adjustment, so it's going to be a big number. Next week is CPI, which has been running a little hot, and Fed Chair Powell spoke about that earlier this week. And then, of course, on the 18th is the FOMC rate decision. So I think once we're through these events, investors can actually then invest into sort of that Christmas Santa Claus rally. So I think 6,300 is still very doable.
So you're basically saying don't go away after the 18th because there may be some additional upside toward the end of the year?
Yes, or buy the dips, yeah.
Let me know your thoughts in the comments and if you're bullish or bearish right now. If you found this video informative, I'd really appreciate your support if you take a second to hit like and consider subscribing for more quick videos on dividend stocks and investing. Have a great day and see you next time.